Chapter 6, Unit 6, Open Economy, International Trade and Finance. Part 6.1, Balance of Payments Accounts. What is the balance of payments? Imagine you're keeping a personal financial diary. Every dollar coming in, every dollar going out, every IOU you sign or collect. Now, scale that up to an entire country, and you've got the balance of payments. BOP. It's the comprehensive record of all economic transactions between a country's residents and the rest of the world over a given period, usually 1 year. The key word here is all. Goods, services, investments, gifts, loans, everything. And here's the beautiful accounting truth that the AP exam loves to test. The BOP always sums to zero. Always. More on why in just a moment. The BOP is divided into two main accounts, the current account and the financial account, sometimes called the capital and financial account. Think of them as two sides of the same coin, or better yet, two columns in that financial diary. Whatever flows one way in real goods and services must be balanced by a flow the other way in money and assets. The current account. The current account is where the real stuff lives, the tangible and semi-tangible exchanges. It has three major components. First, there's the trade balance, which tracks exports and imports of physical goods. When the U.S. sells Boeing jets to Germany, that's a credit, money flowing in. When Americans buy German BMWs, that's a debit, money flowing out. If imports exceed exports, you have a trade deficit. If exports exceed imports, you have a trade surplus. Second, the current account also includes services. Things like tourism, education, and financial consulting. When an international student pays tuition to a U.S. university, that counts as a U.S. export of educational services. Pretty cool, right? Third, there are net income flows, think dividends and wages paid to foreign workers, and net transfers, like foreign aid or remittances, money a worker in the U.S. sends back to family in another country. The formula you want to remember is current account equals trade balance plus net services plus net income plus net transfers. A negative current account balance means the country is spending more abroad than it's earning. It's living a bit beyond its means on the world stage. The financial account. Here's where students often get tripped up, so pay close attention. The financial account tracks the flow of financial assets, investments, loans, and ownership stakes crossing borders. It includes foreign direct investment, like Toyota building a factory in Kentucky, portfolio investment, like a Japanese pension fund buying U.S. Treasury bonds, and official reserve transactions by central banks. Here's the key relationship. The current account and the financial account must offset each other because every transaction has two sides. If the U.S. runs a current account deficit, meaning it imports more than it exports, then money is flowing out of the country to pay for those imports. Where does that money go? It gets reinvested back into the U.S. through the financial account as a surplus. Foreigners use those dollars to buy U.S. assets, real estate, stocks, government bonds. So a current account deficit is always matched by a financial account surplus. This is the double-entry bookkeeping principle at the national level, and it's one of the most testable ideas in this entire unit. A helpful analogy. Imagine you spend more than you earn this month. To cover the gap, you either borrow money or sell something you own. The spending overage is your current account deficit, and the borrowing or asset sale is your financial account surplus. The math always works out. AP exam pitfalls and mnemonics. One of the most common mistakes on the AP exam is confusing the trade deficit with the current account deficit. They're related but not identical, since the current account also includes services and transfers. Don't fall into that trap. Another pitfall, students sometimes think a current account deficit is automatically bad. Not necessarily. A country running a deficit might simply be attracting a ton of foreign investment, which is a sign of economic confidence. The U.S. has run a current account deficit for decades, and investors worldwide still flock to dollar-denominated assets. For the terminology, try this mnemonic. Current account equals current stuff, financial account equals future claims. The current account captures today's flow of goods and services, while the financial account captures claims on future wealth, ownership stakes, and debt instruments. Also remember, when a country's currency appreciates, its exports become more expensive for foreigners, and its imports become cheaper for domestic buyers. This tends to worsen the current account balance, more imports, fewer exports. When currency depreciates, the opposite happens, improving the trade balance over time. This connection between exchange rates and the balance of payments will come up again and again as we move through Unit 6. Putting it together. The balance of payments is essentially the world scoreboard for international economic activity. Every country is simultaneously a buyer and a seller, a borrower and a lender, and the BOP tracks it all with perfect double-entry precision. Whenever you see a question about trade deficits, capital flows, or foreign investment, anchor yourself back to this framework. Current and financial accounts move in opposite directions, and together they always balance to zero. With the BOP framework firmly in hand, we're now ready to explore why currencies change in value in the first place, which takes us directly into the foreign exchange market and the mechanics of exchange rate determination. Part 6.2 Exchange Rates. What is an exchange rate, anyway? Imagine you're planning a trip to Japan. You walk up to a currency exchange booth at the airport, hand over a $100 bill, and walk away with a fistful of yen. The rate at which you made that swap, say 150 yen per dollar, that's an exchange rate. At its core, an exchange rate is simply the price of one currency expressed in terms of another. And just like any other price in economics, this one is determined by supply and demand. The market where currencies get bought and sold is called the foreign exchange market, or forex market, and it operates around the clock across the globe every single day. Appreciation and depreciation. Here's where students most often trip up on the AP exam, so pay close attention. When we say a currency appreciates, we mean it has become more valuable relative to other currencies. It can now buy more of a foreign currency than before. If the dollar appreciates against the yen, your $100 bill might now fetch 160 yen instead of 150. On the flip side, depreciation means the currency has lost value. It buys fewer units of the foreign currency. A good memory trick: think of appreciation like a stock going up and depreciation like a stock going down. The currency's price moves just like any asset. Now here's the AP pitfall hiding in plain sight. Students often confuse which way a change affects imports and exports. When the dollar appreciates, American goods become more expensive for foreigners, so U.S. exports fall. At the same time, foreign goods become cheaper for Americans, so U.S. imports rise. The net effect? The trade balance likely worsens. The current account moves toward deficit. Flip it around for depreciation. A weaker dollar makes our exports cheaper and our imports more expensive, which tends to improve the trade balance. The acronym DIME can help you here. Depreciation, I increases. Made in America, E exports. Supply and demand in the forex market. Think of dollars in the forex market the same way you'd think about apples at a farmer's market. The demand for dollars comes from foreigners who want to buy American goods, services, or financial assets. They need dollars to do that. The supply of dollars comes from Americans who want to purchase foreign goods, services, or assets. They're essentially trading their dollars away to get euros, pesos, or pounds. When something increases demand for dollars, say U.S. interest rates rise and foreign investors rush to put money into American banks, the demand curve for dollars shifts right and the dollar appreciates. When something increases the supply of dollars, maybe Americans develop a sudden obsession with Italian sports cars and start buying them by the thousands. The supply curve shifts right, and the dollar depreciates. Always draw this graph with the exchange rate, price of the dollar in foreign currency, on the vertical axis and the quantity of dollars on the horizontal axis. It looks just like any other supply and demand diagram, and the AP exam loves asking you to shift those curves. Interest rates and the exchange rate connection. One of the most important relationships in this whole unit is the link between interest rates and exchange rates. When a country's interest rates rise, its financial assets become more attractive to foreign investors seeking higher returns. Those investors need to buy that country's currency to invest there, which increases demand for the currency and causes it to appreciate. This is a critical chain reaction you need to have memorized cold. Higher interest rates increase demand for the currency. Currency appreciates, exports fall, imports rise, trade balance worsens. You'll see this chain tested across multiple free response questions every single year. Purchasing power parity. The AP exam also touches on a concept called purchasing power parity, or PPP. The idea is elegantly simple. In the long run, exchange rates should adjust so that identical goods cost the same across countries. The classic illustration is the economist's Big Mac index. If a Big Mac costs $5 in the US and the equivalent of $3 in another country at current exchange rates, PPP theory suggests the country's currency is undervalued. While PPP is more of a long-run benchmark than a precise formula, knowing it exists and what it means is enough for the AP exam. Fixed versus flexible exchange rates. Finally, you should know the difference between a flexible or floating exchange rate system and a fixed exchange rate system. Most major economies today, the US, the Eurozone, Japan, use flexible exchange rates, meaning the market determines the rate freely. Under a fixed exchange rate, a government pegs its currency to another. Historically, many currencies were pegged to the dollar or to gold. Maintaining a fixed rate requires the central bank to intervene, buying or selling its own currency to keep the exchange rate stable. The AP exam may ask you to identify what a central bank must do to defend a peg. So remember, if your currency is depreciating toward the floor of the peg, you buy your own currency, using foreign reserves, to prop it up. With exchange rates firmly in your toolkit, you're ready to see how they connect to the broader story of international trade flows and the balance of payments, which is exactly where we're headed next. Part 6.3, the foreign exchange market. What is the foreign exchange market? Imagine you're planning a trip to Japan. You've got dollars in your wallet, but Tokyo doesn't want your dollars. They want yen. So before you even board the plane, you're already a participant in one of the largest and most liquid markets on Earth, the foreign exchange market, or Forex market. This is where currencies are bought and sold, and it's the beating heart of international trade and finance. The exchange rate is simply the price of one currency expressed in terms of another. If the exchange rate between the US dollar and the Japanese yen is 150, that means $1 buys you 150 yen. Simple enough. But the AP exam loves to test whether you understand what happens when that rate changes, and why. So let's dig in. Demand and supply of currency. Here's the key insight. A currency is just like any other good. It has a demand curve, a supply curve, and a price determined by where those two curves meet. The price of the dollar, for example, might be expressed in euros or yen. What creates demand for US dollars? Foreigners need dollars when they want to buy American exports, invest in US assets, or visit the US as tourists. Think of it this way. If a French company wants to buy a Boeing aircraft, it needs dollars to make that purchase. So the demand for dollars is really the demand for everything America sells to the world. What creates supply of US dollars? Americans supply dollars to the Forex market when they want to buy foreign goods, travel abroad, or invest in foreign assets. When you swipe your card at a cafe in Paris, you're effectively supplying dollars to the market in exchange for euros. Appreciation and depreciation. Now here's where students most often trip up on the AP exam, so pay close attention. When the demand for dollars rises, say, because US exports suddenly become very popular, the dollar appreciates, meaning it buys more foreign currency than before. Conversely, when Americans flood the market with dollars to buy lots of imports, the dollar depreciates, meaning each dollar buys fewer units of foreign currency. A helpful way to keep this straight: appreciation is good for importers, bad for exporters. If the dollar strengthens, your dollars go further abroad. Great for buying a German car. But that same strong dollar makes American goods more expensive for foreigners, which hurts US export industries. Depreciation flips the script entirely. Here's a mnemonic that students love: strong dollar, weak exports; weak dollar, strong exports. Say it a few times, it'll save you on exam day. The Forex graph. On the AP exam, you'll almost certainly need to draw or interpret a Forex market graph. Picture a standard supply and demand diagram. The vertical axis shows the exchange rate, the value of the dollar in terms of a foreign currency. The horizontal axis shows the quantity of dollars exchanged. The demand curve slopes downward. As the dollar gets cheaper, foreigners want more of it. And the supply curve slopes upward. As the dollar gets more valuable, Americans are incentivized to supply more of it to buy cheap foreign goods. When something shifts demand or supply, like a change in interest rates, income levels, or trade preferences, the curve moves and the equilibrium exchange rate changes accordingly. For instance, if the Federal Reserve raises interest rates, US assets become more attractive to foreign investors. They need dollars to invest here, so demand for dollars increases, the demand curve shifts right, and the dollar appreciates. This is a critically important chain of reasoning for Unit 6. Interest rates and the Forex connection. Speaking of interest rates, this is probably the single most tested relationship in this entire section. The logic runs like this. Higher US interest rates, more attractive US financial investments, increased foreign demand for US dollars, dollar appreciates, US exports become more expensive abroad. net exports may fall. That's a long chain, but every link matters. Practice tracing it forward and backward until it feels automatic. Common AP pitfalls. One classic trap: confusing appreciation with depreciation because the numbers seem to move in a counterintuitive direction. If the exchange rate goes from $1 equals €1 to $1 equals 1.2 euros, the dollar has appreciated. It now buys more euros. Students sometimes see the bigger number and think the rate went up, so the currency got weaker. Nope. More foreign currency per dollar means the dollar is stronger. Another pitfall: forgetting that exchange rates are reciprocal. If the dollar appreciates against the euro, then by definition, the euro has depreciated against the dollar. You can't have one currency get stronger without the other getting weaker. Putting it all together, the foreign exchange market is really just supply and demand wearing a passport. Every shift in this market connects back to something real: trade patterns, investor confidence, central bank decisions, consumer preferences. Once you see those connections clearly, the graphs and the logic click into place like puzzle pieces. With a firm grasp of how currencies are valued and what makes them move, you're perfectly positioned to explore how exchange rate fluctuations ripple through the broader economy, which is exactly what we'll tackle next as we examine the balance of payments and its relationship to everything we've covered so far. Part 6.4: Effect of Changes in Policies and Economic Conditions on the Foreign Exchange Market. All right, let's talk about one of the most satisfying puzzles in all of macroeconomics: how the decisions made by governments and central banks ripple all the way into the foreign exchange market. If you've ever wondered why the dollar gets stronger when the Fed raises interest rates, or why a country running a massive budget deficit might see its currency wobble, you're about to get your answers. The foreign exchange market, a quick grounding. First, a quick reminder of what we're working with. The foreign exchange market, the Forex market, is simply where currencies are bought and sold. The price of one currency in terms of another is called the exchange rate. When we say the dollar appreciates, it means $1 now buys more of a foreign currency. When it depreciates, it buys less. Think of it like the dollar's purchasing power passport. A stronger passport gets you more abroad. The Forex market, like any market, has a demand curve and a supply curve. Demand for dollars comes from foreigners who want to buy American goods, services, or assets. Supply of dollars comes from Americans who want to buy foreign goods, services, or assets. Whatever shifts that demand or supply shifts the exchange rate. How monetary policy moves the Forex market. Here's where it gets really juicy. Imagine you're an investor sitting on a pile of cash. You want the best return possible, so you're scanning interest rates around the world. The United States suddenly raises its interest rates. What do? You move your money into U.S. assets, obviously, but to buy U.S. bonds or park money in American banks, you need dollars. So you demand more dollars, which drives up the value of the dollar. The dollar appreciates. This is the classic monetary policy, interest rates, capital flows, exchange rate chain. It's one of the most important chains in all of Unit 6, so burn it into your memory. An expansionary monetary policy, lower interest rates, works in reverse. Lower rates make U.S. assets less attractive, capital flows out, demand for dollars falls, and the dollar depreciates. A useful mnemonic: tight money, tight dollar. Contractionary policy tightens the money supply and strengthens the dollar. How fiscal policy enters the picture. Now, let's layer in fiscal policy. When the government runs an expansionary fiscal policy, think tax cuts or increased spending, it typically borrows more money by selling bonds. More bonds flooding the market means bond prices fall. And since bond prices and interest rates move inversely, interest rates tend to rise. Higher interest rates attract foreign investment, demand for dollars increases, and you guessed it, the dollar appreciates. This is the mechanism behind something called crowding out, and it has an open economy twist. The stronger dollar actually makes American exports more expensive and imports cheaper, which can worsen the trade balance. The AP exam loves asking you to trace these multi-step chains, so practice saying them out loud like a story. Government spends more, borrows, more interest rates rise, dollar appreciates, exports fall, imports rise, net exports fall. Changes in income, inflation, and tastes. Beyond policy, several other economic conditions shift the Forex market. If U.S. income rises, say, during an economic boom, Americans buy more of everything, including imports. To buy foreign goods, they supply more dollars onto the Forex market, increasing the supply of dollars, which causes the dollar to depreciate. Inflation is another biggie. If U.S. prices rise faster than prices in other countries, American goods become relatively more expensive. Foreigners buy fewer of them, so they demand fewer dollars. Meanwhile, Americans hunt for cheaper foreign goods, supplying more dollars. Both effects push the dollar downward. The key concept here is purchasing power parity. In the long run, exchange rates adjust so that the same basket of goods costs the same across countries. Finally, changes in tastes and preferences matter too. If the world suddenly falls in love with American tech products or Hollywood films, foreigners demand more dollars to purchase them, and the dollar appreciates. Simple, but the AP exam will absolutely test whether you can identify what shifts the demand curve versus the supply curve for a currency. Reading the Forex graph. On the AP exam, you'll likely need to draw or interpret a Forex market graph. The x-axis shows the quantity of dollars. The y-axis shows the exchange rate expressed as, say, euros per dollar. A rightward shift in demand raises the exchange rate, appreciation. A rightward shift in supply lowers the exchange rate, depreciation. A common pitfall is confusing appreciation with depreciation when reading the graph. Remember, if the price of the dollar on the y-axis goes up, the dollar is worth more. That's appreciation. Full stop. Another classic AP trap. Students sometimes think a stronger dollar is always good. For exporters, a stronger dollar is actually painful. Their goods become pricier for foreign buyers. Context always matters on the exam. Tying it together. The through line of this entire section is that the Forex market doesn't exist in isolation. It's the destination where monetary policy, fiscal policy, income changes, and inflation all eventually arrive. Every major macroeconomic shift sends a signal into the Forex market, and your job is to trace that signal clearly and confidently. With the Forex market now firmly in your toolkit, we're ready to put everything together and examine how all these open economy variables interact through the full lens of the balance of payments, which is exactly where we're headed next. Part 6.5 Changes in the Foreign Exchange Market and Net Exports. Why exchange rates are never standing still. Picture this. You're planning a trip to Japan, and last month $1 bought you 130 yen. This week, it only buys 110. Suddenly, that ramen you were dreaming about just got about 15% more expensive in dollar terms. That shift, that movement in the exchange rate, is exactly what this section is all about, and it ripples far beyond your travel budget. Exchange rates are constantly moving, and those movements reshape the entire landscape of international trade. Let's build this carefully, because the AP exam loves to test whether you truly understand the cause and effect chains here, not just the vocabulary. What causes the exchange rate to change? Think of the foreign exchange market exactly like any other market. The price of a currency, the exchange rate, is determined by supply and demand. When demand for US dollars rises, maybe because foreign investors want to buy American assets, or because American exports are suddenly popular, the dollar appreciates, meaning it buys more foreign currency. When demand falls, or when the supply of dollars increases, the dollar depreciates. Several forces shift these curves. A rise in U.S. interest rates, for instance, attracts foreign capital because investors chase higher returns. To buy those American bonds or savings accounts, foreigners need dollars, which increases demand for the dollar and appreciates it. On the supply side, if Americans suddenly develop a passion for imported Italian espresso machines, they're supplying dollars to the foreign exchange market, which can depreciate the dollar. Inflation differentials matter too. If the U.S. has higher inflation than its trading partners, American goods become relatively more expensive, demand for dollars softens, and the dollar depreciates. Keep this mental map. Interest rates up, dollar appreciates. Inflation up relative to others, dollar depreciates. The crucial link to net exports. Here's where it gets beautiful, because everything connects. Net exports are simply exports minus imports. NX equals X minus M. When the dollar appreciates, your currency goes further abroad, so imports become cheaper for Americans. Think less expensive German cars or French wine. At the same time, American goods become more expensive for foreigners, so exports fall. Cheaper imports plus fewer exports means net exports decrease. The trade balance moves toward deficit. Flip it around, when the dollar depreciates, American goods look like bargains to the rest of the world, so exports rise. Meanwhile, imports become more expensive for Americans, so they import less. Net exports increase. This inverse relationship between the exchange rate and net exports is one of the most testable ideas in all of macroeconomics. So, say it out loud: dollar up, net exports down, dollar down, net exports up. Connecting to aggregate demand. Now, here's the chain the AP exam absolutely adores. Net exports are one of the four components of aggregate demand, AD equals C plus I plus G plus NX. So when net exports change, aggregate demand shifts. A dollar appreciation reduces net exports, which pulls aggregate demand to the left, output, and the price level fall, all else equal. A depreciation boosts net exports, shifts AD to the right, and stimulates the economy. This creates a fascinating feedback loop that shows up in monetary policy questions. Suppose the Fed raises interest rates to fight inflation. Higher rates attract foreign investment, the dollar appreciates, net exports fall, and aggregate demand decreases. That's actually a second contractionary channel beyond the traditional higher rates reduce investment story, and the AP exam will test whether you can trace that full sequence without missing a step. The common pitfalls that haunt students. The most dangerous trap is confusing appreciation and depreciation. A helpful mnemonic, dude, dollar up, demand for exports, down. Burn that into your memory. When the dollar strengthens, your exports get hurt because foreigners now pay more in their own currency for American goods. Another pitfall is forgetting that changes in net exports affect the AD curve, not the AS curve. Exchange rate changes are a demand-side story. Also, be careful not to say that a trade deficit is automatically bad. The AP exam wants you to analyze consequences, not make moral judgments about trade balances. Finally, watch for questions that combine fiscal or monetary policy with exchange rate effects. If the government runs expansionary fiscal policy, interest rates may rise, crowding out, which appreciates the dollar, which reduces net exports, partially offsetting the expansionary effect. This is sometimes called the open economy crowding out effect, and it's a favorite multi-part question topic. Putting it all together, every movement in the foreign exchange market sends a signal through the whole economy. A stronger dollar makes Americans feel richer at the airport, but quietly squeezes manufacturing towns whose goods become hard to sell overseas. A weaker dollar can be a powerful stimulus for exporters, even as it pinches consumers paying more for imported goods. The exchange rate is the bridge between domestic macroeconomic policy and the wider world, and understanding how it shifts and what those shifts do to net exports and aggregate demand gives you a complete, interconnected picture of how modern economies actually work. With that foundation in place, we're ready to zoom out even further and examine how all of these forces, trade balances, capital flows, and exchange rates, fit together inside the broader framework of the balance of payments. Part 6.6, Real Interest Rates and International Capital Flows. Why money crosses borders. Imagine you have $10,000 sitting in a savings account. Your bank is offering you 2% interest. Then your friend mentions that banks in another country are offering 6% on similar deposits. What do? If you can, you move your money. This simple instinct, chasing higher returns, is exactly what drives international capital flows, and it's the heart of everything we're covering in this section. Capital flows are the movement of financial assets across national borders. When investors, banks, or businesses move money into a country to take advantage of investment opportunities, that's a capital inflow. When money leaves a country seeking better returns elsewhere, that's a capital outflow. The single most powerful magnet for these flows is the real interest rate. Real versus nominal, the distinction that always shows up on the exam. Here's a classic AP trap. The nominal interest rate is the rate you see advertised, the headline number. But the real interest rate is what actually matters to investors, because it accounts for inflation. The formula you need burned into your memory is real interest rate, nominal interest rate minus inflation rate. Think of it this way. If your bank pays you 5%, but inflation is running at 4%, you're only gaining about 1% in actual purchasing power. That 1% is your real return. Investors making cross-border decisions care deeply about real rates, not the flashy nominal figures. When a country has a high real interest rate, it's genuinely rewarding lenders. When real rates are low or even negative, smart money tends to walk out the door. The mechanism, how real interest rates drive capital flows. Here's where the gears really start turning. Suppose the United States raises its real interest rate. Maybe the Federal Reserve tightens monetary policy to fight inflation. Suddenly, U.S. bonds, savings accounts, and financial assets look more attractive to investors around the world. Foreign investors want in. They start buying U.S. financial assets, which means they need U.S. dollars to do so. This surge in demand for dollars causes the dollar to appreciate on foreign exchange markets. This relationship is one of the most tested chains of logic in all of AP Macro. So let's walk it slowly. Higher real interest rates, increased demand for domestic financial assets, increased demand for domestic currency appreciation. Run that movie in reverse and you get the opposite. Lower real interest rates, capital outflows, decreased demand for domestic currency depreciation. A helpful mnemonic to lock this in. Rates rise, dollars fly in. When real rates rise, foreign capital flies into the country. Connecting to the loanable funds market. You've already seen the loanable funds market, that graph where the supply of loanable funds slopes upward and the demand slopes downward, with the real interest rate on the vertical axis. In an open economy, international capital flows become part of that story. If a country's real interest rate is above the world real interest rate, foreign capital will pour in, effectively increasing the supply of loanable funds and pushing the domestic real interest rate back down toward the world rate. This is the self-correcting magic of open capital markets. The key insight for the AP exam is that in a small open economy, the domestic real interest rate is essentially anchored to the world real interest rate. If it drifts too far above or below, capital flows bring it back. The balance of payments connection. Capital flows don't happen in a vacuum. They show up in a country's financial account, sometimes still called the capital account on older AP materials. A net capital inflow, more money coming in than going out, means a positive financial account balance. And here's the accounting identity the AP loves to test. The current account and the financial account must sum to zero. So if a country is running a financial account surplus, capital inflows, it must be running a current account deficit, importing more than it exports. These two sides of international finance are mirror images of each other. Countries that attract lots of foreign investment tend to run trade deficits, not because they're weak, but because all that incoming capital has to show up somewhere in the balance of payments. Common AP pitfalls. One of the most common mistakes students make is confusing the direction of currency movement. Remember, it's the demand for the currency that shifts. If foreigners want to invest in the US, they must first buy dollars. More demand for dollars means the dollar strengthens. Students sometimes flip this and say the currency depreciates, which is backwards. Also, be careful not to mix up real and nominal rates on free response questions. The exam will sometimes give you a nominal rate and an inflation rate separately, expecting you to calculate the real rate before proceeding. Don't skip that step. Another pitfall is forgetting that capital flows are forward-looking. Investors move money based on expected returns and risk, not just current conditions. If a country's central bank signals future rate increases, capital can start flowing in before the rate actually changes. Putting it all together. The elegant takeaway here is that real interest rates act like gravity for financial capital. Money naturally flows toward the highest real return, and this movement reshapes currency values, trade balances, and even domestic interest rates. The chain of causation from monetary policy to capital flows, to exchange rates, to net exports is one of the most powerful storylines in all of macroeconomics, and understanding it deeply will serve you well across multiple sections of the AP exam. With this foundation in place, you're ready to explore how exchange rate changes ripple through an economy and affect a country's export competitiveness, which is exactly what we're looking